Hey everyone, I have here with me today my wife's new baby. She's had this dog for about a couple months now and he is spoiled rotten and is attached to her hip. So while she's at the store, little man's in my arms and is going to help us through this video. He's got to take a nap, so hopefully he does this entire time. We'll find out. So let's dive right into it. If you invest into condos or townhomes, or you're using DSCR loans to build a portfolio, 2026 just quietly changed the rules on you. We're seeing the biggest shift in HOA oversight and condo financing that we've had in years. And most investors, they're just not paying attention yet. In this video, I'm going to break down what's happening with your HOA reform, how new rules in states like Georgia, Florida, and Texas work together with the new Fannie and Freddie condo guidelines, and what exactly that means for you and your DSCR strategy going forward. So stay tuned to the end because I'm going to show you where I think the next wave of opportunity is in condo and townhome investing. So let's zoom out for a second and let's get into some details. In the U.S., we now have about 373,000 community associations. That includes HOAs, condo associations, and co-ops. That all covers roughly 78 million Americans and $13.1 trillion in housing value. So, out of all that, there's 2 out of 3 of the new homes that are built, and over 80% of homes sold in 2025, they were all in some kind of HOA governed community. So when you and I talk about DSCR loans, a small multifamily, and condos or townhomes, we're not just talking about a niche corner of the market anymore. We're talking about the main housing product in a lot of different metros. Historically, though, HOAs have been the biggest blind spot in underwriting books. Surprise special assessments, aggressive boards, and in some states, the power to foreclose over a few $1,000s in unpaid dues. That has scared a lot of investors away from condos and townhomes or forced them into higher cost non-qualified mortgages because the project just couldn't qualify for conventional mortgages. So now let's talk about the biggest single change. Georgia just passed a bill, SB 406, the Georgia Property Owners Bill of Rights. This is the most comprehensive HOA oversight bill in Georgia's history. And it's already passed the Senate unanimously. And the House, 155 to 10. So it's got massive approval ratings in Georgia. And it's sitting on the governor's desk with an expected effective date of January 1st of 2027. Before this bill, Georgia basically had no laws governing HOAs. No state office in charge of them, even though there were more than 11,300 associations serving over 2.5 million people. Here are a few investor-focused highlights. So mandatory registration. Every HOA now has to register annually with the Secretary of State and file financials with the state able to suspend or revoke that registration if there's misconduct. Foreclosure threshold has now doubled, which is awesome. HOAs can't foreclose until there's at least $4,000 is owed and the owner is at least 1 year in the rears. Double the previous $2,000 threshold, right? So if they rack up $4,000 in HOA fines, they can't just foreclose. You also have to be a year behind in your dues. So just pay your dues. They can't foreclose. And there's no insider bidding at foreclosure. This is huge, right? The HOA and board members, their families, and the related entities are now barred from bidding at their own foreclosure sales. Financial transparency. Books have to be kept for 10 years. Annual financials are filed with the state, and members have the right to inspect their records. Board residency and homeowner rights. Board members must actually live in the community, and owners get codified rights like notice before foreclosure, access to insurance certificates, and the ability to challenge conflicts of interest. So that means they can't target individuals anymore. So if you're an investor, you have a little bit more say in what's going on, and they can't just target you and your building because you're an investor. From a DSCR perspective, what this does is it turns a black box into something that you can underwrite. So instead of hoping that the HOA isn't a ticking time bomb, you can look at registered financials, reserves, and litigation history before you close. So you know if you're walking into one of those Karen type situations in the HOA board. So which all that means is fewer deals die at the 11th hour. Georgia is not alone here, and this is great. There is a national wave of HOA reform happening. Examples: Florida's HB 1203, fully effective January 2026, caps most fines at $100 per violation, makes kickbacks a third-degree felony. Woo, that is awesome. And requires audits and transparency websites for a larger association. Texas laws like SB 711 and SB 1588 require online governing documents, allow electronic voting, protect solar roof tiles, and forbid fines for drought-related brown loans. California's AB 130 adds its own $100 fine caps and improves owners' rights to curb violations before fines escalate. Other states like Colorado, Arizona, Montana, and Minnesota are now tightening foreclosure rules as well. They're limiting attorney fees, and they're restricting abusive covenant enforcement. Why should you care as an investor about all this, right? You're not going to live in these communities. Well, it's because HOAs used to be are used to be able to weaponize their fees and legal costs in a way that could wipe out years of cash flow if you get in a dispute. Reform that caps fines, create a cheaper dispute resolution path, and force transparency directly reduce your tail risk. The catastrophic one nightmare board member, the Karens, so to speak, scenarios. They all also make tenants live more predictable in HOA communities, which means lower turnover and vacancies, both of which feed straight into your DSCR, straight into your pocket. At the same time, Fannie and Freddie have rolled out new major condo rule changes that hit in 2026 and 2027. This is a big one. The 50% investor concentration limit, it's now gone as of March 18th, 2026. So it's gone already. That means that condos were previously locked out of conventional financing because too many units were non-owner occupied now qualify. The door to lower rates and better terms compared to non-QM and or DSCR only execution. The trade-offs are the limited revenue, the limited review process of being eliminated later in 2026, which means more full file reviews and longer closing times, but with better financial vetting of the project, so you don't have to inherit ugly surprises. Reserve requirements are increasing from 10 to 15% of the annual budget in early 2027. The reserve studies have to use the highest recommended funding level. In plain English, HOA dues may go up in some buildings as they catch up on reserves, but the projects that make it through this transitions are going to be more stable, more warrantable, and less likely to hit you with a massive special assessments. For those of you that have been in the market before that are trying to purchase homes from Fannie and Freddie, they're not investor friendly. So what this also means is that Fannie and Freddie are finally starting to catch up to the real times, and they're becoming more investor friendly for us. And they're trying to show that by making these changes for condos and townhomes. Let's all connect the dots here, right? In DSCR underwriting, HOA dues sit in the I of PITA, right? And your ratio is simply annual gross rents divided by annual debt service. So nationally, HOA fees have been increasing faster than rents in some markets, with cities like Tampa and Orlando seeing double-digit jumps, which eat into your DSCR and kill your deals at the margin. So reforms that cap fees, force realistic reserve funding, and make financials visible in advance help keep that denominator, your annual PITA, more predictable over time, right? So, meanwhile, the elimination of the investor concentration cap means you can target buildings that used to be non-financeable conventionally, layer in a DSCR conventional options, and potentially pick up units at a discount now while the market catches up to these rule changes. And in this all adds a new oversight that make it harder for HOAs to enforce extreme renter restrictions or exercise rights of first refusal that block investor buyers. And you've got a cleaner path now to scaling a condo or townhome portfolio with a lot less random HOA risk, a lot less Karen kind of stuff than you had 3 or 4 years ago. So, if you've written off condos and townhouses because of horror stories of all these Karens out there, or Bobs, I think they call them now, 2026 and 2027 might be your window to revisit that thesis. If you want help stress testing HOA dues, DSCR, and warrantability on your next deal, reach out. This is exactly the kind of underwriting environment we're having right now. Having the right lending partner gives you an edge. So hit like and subscribe. Drop a comment if you want to break down the specifics in your state of HOA reform or just a deeper dive into the condo guidelines. I'm here to help you guys. My direct number, you can also call me, is 208-215-9936. I would love to talk about these deals. I'd love to talk about how we can structure it to help you. I appreciate every guys for tuning in. Louis, he's named after Louis Vuitton because it's our bougie dog. I'll talk to you guys soon. Have a fantastic weekend. Stay safe, everyone.